In a market where tech giants are rewriting the rules of wealth creation, the choice between QQQ and SPY has separated investors who chase explosive growth from those who prioritize steady, broad-based stability, potentially leading to vastly different outcomes for your portfolio over the coming years. As we navigate economic uncertainties in 2025, grasping this comparison is essential for anyone serious about building wealth, whether through retirement accounts or personal investments, because it directly impacts your exposure to innovation versus the full spectrum of U.S. corporate power. Let's dive right in by unpacking what these ETFs really are, keeping things straightforward so anyone can follow. SPY, officially the SPDR S&P 500 ETF Trust, mirrors the S&P 500 index, which tracks the 500 biggest U.S. companies by market cap. It first hit the market on January 22, 1993, and has become the gold standard for broad market exposure. Right now, its assets under management sit at $676.92 billion, with a super low expense ratio of 0.09%, meaning you keep more of your returns instead of paying hefty fees. This makes SPY a go-to for investors wanting a piece of everything from banks to burgers, offering that classic diversification to smooth out the ride. Contrast that with QQQ, the Invesco QQQ Trust, which shadows the NASDAQ 100 index, focusing on the 100 largest non-financial NASDAQ-listed companies, many of them tech trailblazers. Launched on March 10, 1999, QQQ boasts assets under management of $385.59 billion and an expense ratio of 0.20%. A bit higher, but still a bargain for its targeted punch. Picture SPY as your reliable family sedan, cruising through all terrains, while QQQ is the high-octane sports car accelerating hard on innovation highways but risking a bumpier journey. To see the differences in action, let's look at their holdings. In SPY, the top 10 stocks make up about 38.78% of the fund, blending tech with other stalwarts. Leading are NVIDIA at 7.96%, Microsoft at 6.73%, Apple at 6.61%, Amazon at 3.73%, and Meta Platforms at 2.78%. This mix ensures no one company calls all the shots, like having a diversified team where everyone contributes. QQQ ramps it up with its top 10 holdings comprising roughly 51% of the portfolio, heavily skewed toward tech. Top spots go to NVIDIA at 9.87%, Microsoft at 8.38%, Apple at 8.22%, Broadcom at 5.58%, and Amazon at 5.10%. For a real-life example, think back to the AI boom in 2023 to 2024. QQQ's heavier NVIDIA weighting helped it soar as chip demand exploded, while SPY's broader holdings diluted that upside with slower-moving sectors like utilities. Sector breakdowns highlight this even more. SPY allocates 35.62% to technology, 8.86% to healthcare, 7.52% to industrials, 2.89% to energy, 2.35% to utilities, and 1.94% to real estate, creating a well-rounded snapshot of the economy. QQQ, meanwhile, pours 54.42% into technology, with just 4.22% in healthcare, 3.35% in industrials, 1.37% in utilities, 0.48% in energy, and 0.19% in real estate. If you're betting on electric vehicles taking over, like Tesla's push in the mid-2020s, QQQ would amplify your wins from that sector far more than SPY's balanced approach. Performance is where the rubber meets the road, and the numbers don't lie. QQQ's year-to-date return clocks in at 18.93%, beating SPY's 15.19%. Over the past year, QQQ delivered 26.35% versus SPY's 19.07%. Look at 3 years, and QQQ shines with 32.19% annualized compared to SPY's 24.99%. The 5-year figures show QQQ at 17.35% and SPY at 16.36%, but over 10 years, QQQ pulls ahead at 20.32% against SPY's 15.20%. To put that in perspective, a $10,000 investment in Triple Q 10 years ago would be worth about $66,000 today, while SPY would grow it to roughly $41,000, a $25,000 gap that underscores tech's edge in bull markets. Historically, from 2000 to May 2025, Triple Q edged out SPY with a 7.77% annualized return versus 7.52%, though not without drama. Remember the dot-com crash? Triple Q tanked over 80% from its 2000 peak, far worse than SPY's 50% drop, showing how concentration can bite back. But in the post-pandemic surge from 2020 to 2023, Triple Q doubled investors' money cumulatively, riding waves like remote work and cloud computing, outpacing SPY's respectable but tamer climb. Risk comes hand in hand with those rewards. Triple Q's beta is 1.10, indicating it's 10% more volatile than the market, while SPY's beta is a perfect 1.00. Current volatility metrics show Triple Q at 2.40% compared to SPY's 1.78%, confirming Triple Q's larger price swings. For instance, if you're a young investor with decades ahead, Triple Q's swings might be tolerable for higher potential. But if retirement is looming, SPY's steadier path could help you sleep better, as it did during the 2022 inflation scare when tech faltered more. Dividends and valuations add another layer. SPY yields 1.09%, offering reliable income for those needing cash flow, while Triple Q's yield is a slimmer 0.47% since growth firms plow earnings back into expansion. Valuations reflect this. Triple Q's price-to-earnings ratio is 34.39, betting on future explosions, versus SPY's 28.30. In 2022's rate hike environment, Triple Q suffered more as pricey stocks got hammered, a reminder that economic shifts hit growth harder. Choosing between them boils down to your style. SPY suits core portfolios craving stability, like in a simple buy-and-hold strategy where you invest $500 monthly. Many robo-advisors default to it for its economic mirror. Triple Q appeals if you're bullish on tech's future from AI to biotech and can stomach the volatility. A hybrid approach works too, say 60% SPY for ballast and 40% Triple Q for zest, rebalancing yearly based on your age or goals. Both trade fluidly with current prices at 611.44 for Triple Q and 673.11 SPY as of October 9th. Their turnover rates are low, reducing tax drags in non-retirement accounts. Risk-adjusted, Triple Q often edges out with a sharp ratio of 1.09 versus SPY's 0.97, balancing upside capture. In the end, there's no one-size-fits-all winner. It hinges on your view of the world. If tech's relentless march continues, fueled by breakthroughs in quantum or green energy, Triple Q might dominate. But in downturns, SPY's diversity could safeguard your nest egg. Diversify wisely, consult pros, and treat these as long-haul vehicles. Armed with this insight, you're ready to level up your investing game. If you found this comparison helpful, hit that subscribe button for more in-depth finance breakdowns like this one. You can check the description box below for all the reference links to the data and sources I mentioned. Thanks for watching, invest smartly, and see you next time.